Hey, how's it going, guys? S&P 500 broke out from the all-time high this week. Every mainstream media is calling for a new bull market. From the pure technical perspective, the S&P 500 chart indeed looks like a bull market, and I would not be surprised if the S&P 500 goes up another 20% from here. However, if we deep dive into the US equity market behind those crazy daily price actions, we can actually find some really dangerous and abnormal signals that definitely deserves every single investor's attention. So in this video, I will do an in-depth analysis on the US equity market and share with you guys the top 3 reasons why this bull market may not be as bullish as it seems like. Also, I will show you guys some really important warning signals that you should definitely pay attention to if you have US equities in your portfolio. Alright, let's get started. There is a common belief among investors that the Federal Reserve plus the central bank have the ability to raise the stock market price and create a bull market. Together, they have the power to lower the interest rate and increase the money supply. As the result, the stock market goes up in the short term, and we naturally believe the bull market is back because of the extremely dovish Federal Reserve. But the truth might surprise you. Let's take a look at some histories. The Japanese central bank has been the most dovish central bank in the world for 30 years. They have been doing the unlimited QE since the late 1980s, and they're the only central bank who is directly buying the Japanese stocks and the ETFs. But their stock market peaked in 1989 and has never recovered to make a new high. The rest of the developed countries are facing the same issue. The European central banks have been doing anything they can, whatever it takes, to save the market. But the UK market peaked in 2007, right now is still down 43% in US dollar terms. Italy peaked in 2008, right now it's still down 61% in US dollar terms. For the past 10 years, from 2009 to 2019, the biggest QE action actually came from the Chinese central bank. They printed much more money than what the US did before the COVID crisis. But the Chinese stock market in the US dollar terms peaked in 2015 and has never recovered, still down 20% from the peak. From this chart, we can clearly see that despite all of these countries' central bank have been extremely dovish, doing the unlimited QE for over 10 years, and most of their interest rates are even in the negative territory, much lower than the US, but their stock market hasn't recovered at all. The whole world is still in a deep recession and bear market. So based on the history of the global equity market, the idea that the Federal Reserve can artificially create a bull market right after the worst economic crisis since the 1930s is extremely bizarre and misleading. One of the key reasons the US stock market is very misleading and confused by a lot of investors as the new bull market is this over-concentration on the top 5 large-cap tech companies in the S&P 500 index, which I mentioned quite frequently on this channel. Since May, the top 5 stocks have already taken over almost 25% of the entire S&P 500. And now, by the end of August, the market cap of these 5 companies have increased at an even faster pace than anyone could imagine. Here's the chart showing what I mean. The chart compared the 5 top global equity markets with the top 5 companies in the US. The total combined market cap of the UK, Germany, France, Italy, and Russia's entire stock market is about $6.5 trillion. And the top 5 companies in the US, Facebook, Apple, Amazon, Google, and Microsoft's combined market cap is $7.2 trillion, which means the total 5 companies in the US are even 11% larger than the 5 of the largest stock markets in the world combined together. It's safe to say, for most of the investors, the US stock market has already become more like S&P 5, not S&P 500. If we cut those large cap tech companies out of the index and take a look at the S&P 600 small cap index instead, which truly reflects the real US economy, then we can see that the S&P 600 index peaked in August 2018 and until today is still in the bear market, down 18% from the 2018 peak. This chart of S&P 600 shows a much more realistic picture of where the US economy is truly heading into. And this chart also relatively matches the global equity markets from the rest of the world. So to suggest that the Federal Reserve and the central bank have the ability to directly create a sustainable bull market is not convincing at all. The ones who are actually in this artificial bull market are just a few popular tech stocks that everyone is chasing. The real US stock market is still in the bear market, just like the rest of the world. On a long-term basis, there is very little to even no evidence to show that a long-term sustainable bull market can be created by the extremely dovish monetary and fiscal policies from any country. If the Federal Reserve cannot create a bull market, then what exactly is the factor that is behind this S&P 500 all-time high? And that leads to the next thing I'm extremely worried about. Since the COVID crash, the US stock market has been traded more like a commodity market, not like a typical equity market, and this is a huge problem. Let me explain. There's one extremely important technical indicator called the 10-day breadth thrust that is very commonly used by the institutional investors. So what does this indicator do? Basically, it calculates the number of stocks that were up on the day in the New York Stock Exchange and divided by the total number of stocks listed on the same exchange, and then generate a 10-day moving average of this ratio. It is considered a short-term momentum indicator. Many institutional investors use this indicator combined with a couple of others to signal a potential start of a new bull market. Now let's take a look at what this indicator can tell us this year. On June 3rd, the New York Stock Exchange had a ratio of 1.9 to 1 over the 10-day breadth thrust, which means on the day of June 3rd, the single-day breadth thrust is 1.9 times higher than the 10-day average. This is considered a very extreme momentum signal to the upside. Because it's so rare, it has only happened 17 times since 1950. This chart shows all the histories when the 10-day breadth thrust is greater than 1.9. Alright, I think it's necessary to show you guys why this magical ratio of 1.9 is such a significant number that deserves your attention. From 1950 all the way to 2020, on a random daily basis, which means you randomly pick any day you want, the median maximum return in the S&P 500 over the next 12 months is 9.1%. But if you pick the day when the 10-day breadth thrust is 1.9 or higher, the median maximum return over the next 12 months is 26.3%. You increase your 1-year potential return by almost 200%, and that tells us this is a very powerful level to watch. However, there's something really strange about this signal this year on June 3rd. The market reached the bottom on March 23rd, and the signal only came 2.5 months later. But if we look at the past 16 signals in the history, 90% of them took place within 2 weeks of the low, and 100% all of them happened within the 20 days of the low. But this year, after such a massive crash back in March, based on the history, either we will not get a bullish 10-day breadth thrust signal at all, or we should get such signal within 2 weeks of the March low. Because such extreme upside pressure only happened right after the correctional crash. But we didn't get it until 2.5 months later, after the index had already recovered back to the 78% Fibonacci retracement level. This strange and abnormal time delay can give us two very important clues. First, the ones who were massively selling back in February and March are not the same ones who have been buying since the low, or at least not the majority of them. Second, such market action only exists in the commodity future market, which is heavily leveraged and extremely speculative. Both of these points should be very worrisome to all of the investors, especially those who are overweighting in the US equities. So you probably want to ask, why is that? What happened to the market that caused the US stocks to suddenly act more like commodities and become so speculative? Well, we can find some clues from this Nasdaq to Russell ratio monthly chart. This is the chart that uses the Nasdaq index price divided by the Russell 2000 index price from 1997 to 2020. I call this chart the perfect bubble indicator chart because it shows how concentrated the investors are pumping money into the large cap tech companies and completely ignores the rest of the stock market and the real economy. It only happens once in the entire history that the market is overly concentrated on the tech stocks, and that was back in the famous 2000 dot-com bubble. Right now, we're back to exactly the same highly speculative market again. And this extreme concentration and the speculative sentiments is still trending higher and higher. When the Nasdaq to Russell ratio is approaching to the bubble territory, it tells us the stocks are no longer traded as the equities anymore, as the ownership of the company. They're completely traded as the commodities, which are heavily priced based on the psychological sentiments, technical trends, and the pure supply and demand with zero respect to the underlying fundamental value. This is the very famous Citibank Market Sentiment Index. It measures the panic euphoria level in the US equity market. Whenever the index crosses the upper bound and enters the euphoria zone, we should expect a market correction, sometimes even a major crash like back in March. On the other hand, whenever it enters the panic zone, then it could be a good potential buying opportunity. But what is truly crazy this year is that since May, the US equity market has been at this extreme euphoria level for 4 months in a row and is still growing. The last time the sentiment index level is this high for this long was only back in 2000, again the dot-com bubble. Also, if we look at the US equity 10-day put-to-call ratio, on June 23rd, the put-to-call ratio hit the lowest point since September 2000. What this put-to-call ratio measures is kind of similar to the market sentiment index, but in a much shorter term. When this put-to-call ratio is high, we call it the risk-off market mode, which means the investors are becoming much more conservative and much less willing to take a risk. When the put-to-call ratio is low, it suggests a risk-on market mode. That means investors are willing to take more risk and buy more risky assets like stocks. Right now, we're at the lowest point of this 10-day put-to-call ratio. That indicates the investors are irresponsibly taking massive risk in the stock market with massive leverage. The last time this ratio hit at such a low level was back in 2000, right before the dot-com bubble popped and the big Nasdaq crash. So who are the ones behind that are driving this extreme euphoric sentiment in the US stock market? As we all know, there are two major players in the market, the institutional players and the retail players. On the institutional side, except those flexible and less regulated hedge funds, most of the large institutional funds, for example the pension funds, the insurance companies, they all have a minimal annual target return to hit for their clients. It's either set by the government or the industry standard. In the past decade, it was easy to hit those targets by just simply overweighting the US Treasury bonds. But such asset allocation doesn't work in 2020 anymore because the US Treasury bonds collapsed to the extremely low level. And outside of the US, more than 70% of the foreign bonds are having negative yields. So it forces those institutional fund managers to reallocate a huge amount of their capital into the more risky stock market just for the yield and chase the performance to meet their minimum target. That's why this year, one of the most popular insider jokes on Wall Street is bonds for gains, stocks for yield. And that is not good at all because it forces the massive institutional money to passively speculating on those popular stocks just for the sake of performance chasing. On the retail side, we're seeing a huge spike on the numbers of new trading accounts opening since the COVID crisis. All the online brokers are seeing an unusually high new accounts opening numbers during this pandemic. The most ridiculous is the Robinhood. They almost doubled their account users in just 2 months' time from March to May. Most of those new retail traders have a minimal amount of financial knowledge. When all the real casinos are closed, they treat the stock market more like an online casino. And what do they buy? Well, you guess it, the large cap tech companies. And on top of that, which is even more dangerous, is that the major financial institutions have been creating a large amount of heavily leveraged financial products that are actually available for new retail players to trade. Most of those new retail traders have no idea how those complex trading instruments work and what are the risks involved. That is why we're seeing these tragic stories like this. The new traders took extreme action due to the desire to make quick money but the lack of financial knowledge. Also recently, there has been a trend where companies like Apple and Tesla announce stock splits, which have absolutely no impact on their fundamentals and underlying businesses, but their share price immediately went up on the news. Retail traders are leveraging to the max to buy those stocks, and this is exactly the market behavior that happened a lot during the late 1990s tech stock mania. Just by observing what the retail players are doing, it does feel like 99 to 2000 all over again. So on the institutional side, we're having this passive performance chasing in the stock market due to the treasury yield collapse. And on the retail side, we're having a massive speculation with the high leverage by the inexperienced new market players. And that is why we're seeing this premature, extreme euphoric sentiments in the US stock market right after the huge crash, which is very unusual. And that worries me. Alright, so here are the 3 main reasons why I'm extremely concerned about this potential new bull market called by the mainstream media. Before we finish, there are a couple of things I would like to highlight here. Although these are the things that I'm really concerned about, they are not the immediate sell signal yet, at least not for now. I would say most likely we will see some early signs the market will come back down again by the early of next year, not this year. The main purpose of making this video is to help you guys see the other side of the stock market behind this rally and have a full picture of what is truly going on in the market before you make any buy or sell decisions. I'm not selling my stocks yet, but I'm not buying any US stocks for the past 2 to 3 weeks either. I'm limiting my total US equity exposure to strictly 25% of my entire portfolio at this moment. The US stock market right now is really overcrowded. If you are new to the financial market, there's one thing you should understand about the stock market is that it is a forward pricing mechanism. I won't be surprised if the market goes up another 20% from here because the more and more investors are rushing to pricing any future growth into the current price. But the key thing you need to realize is that based on our current economic environment, the higher the stock market goes from here, the lower the potential return you will have for the next 10 years because most of them have been already pricing. And that's why I choose to stay cautious without taking any extra risk in the US equity market at this moment, and I choose to put more money on the other markets that offers much better potential risk rewards, like precious metals, emerging market equities, and even Bitcoin. Remember, the stock market is not the only place where we can make money. Take a step back, see the bigger picture, and then you will realize that there are actually many other opportunities out there too. Alright, that will be the end of this video. If you are new to this channel, my name is Vic. I make videos every week to share some of my thoughts on what is going on in the financial market, and also what are the trade ideas or what investment opportunities that you should pay attention to in the market. If you are interested in the world of finance and the business and find my videos being valuable to you, please consider subscribing. Thanks so much for watching, guys, and I'll see you guys soon.